France has made deep changes in terms of labor law in 2016. Agreement between the management and the employees are now prevailing compared to agreements at a branch or industry level. In addition, unions are quite powerful and have influence on worker and workforce, and those unions have to be considered when doing a transaction. On top, the law also changed in 2014 when you are now doing a transaction, especially a sell side, you have to tell the employees that you are contemplating a sale of a company. This creates, of course, confidentiality issues, and this creates also further risk for the transaction.
French authorities are very strict regarding tax payment and do not leave any room for negotiations. Fraud usually results in severe penalties. There is a unique tax rate for companies in France which amount to 33%.
The French private equity landscape is quite developed. That's an industry which was more or less created at the end of the 80s or beginning of the 90s. And now we can see that there are close to 300 companies part of what was formerly the AFIC, now France Invest. That means that there is a lot of competition among those players, given the fact that France has a limited market, even if it's well or more developed than Switzerland. We can see that LBOs are not only now primary LBOs, but more secondary or tertiary LBOs. As the industry is developed, this means there is more competition, and this means that investors have money to invest now, not only in France, but also abroad like Germany or Switzerland.
Vendor due diligence, or VDD, is extremely common in France regardless of the size of the deal. Furthermore, this type of service is often required by banks or private lenders in order to finance a deal.